everybody, I'm Stacy.
And I'm Mickey, her daughter.
And welcome to KiddieNomics. Today is a special day. We are so excited for our special guest today that is going to be talking all about mortgages, right? Yes. So before we get started, I would just like to go through some housekeeping stuff. So first off, just through these times, we just like to thank all of the doctors, the nurses, the teachers, especially the teachers, the grocery store attendants, the police, the delivery men and women that are here just keeping us safe and healthy through this time. So we just really want to thank you guys, okay? Also, another housekeeping item, just in case anything happens through the webinar, just know that you can, if the sound is not working, just use the mic at the bottom of your screen. And what you can do is use the arrow button and dial in through the phone. So you can use your cell phone or your house phone to dial in case the audio cuts out for you, or just log out and then log back in, because that usually gets rid of the bugs that you may have. And then you should be able to hear us just fine. Okay, awesome. So KiddieNomics is here to help kids from ages 8 and up to develop a really healthy relationship towards financial literacy, just helping kids to start off on a right, successful path to have a great, successful financial future. So today with us, our special guest is Michael Marini. He's a mortgage broker with Dominion Lending Center's Bedrock Financial Group, number 12275. Michael Marini has been listed on the top 50 brokers with Dominion Lending Centers and was entered in the Dominion Lending Centers Hall of Fame last year. Yay, Mike! His primary focus and goal is to educate his clients so that they can make the best decision possible when it comes to obtaining a mortgage. He and his team place over $60 million a year in mortgage volume. So can we give a big KiddieNomics welcome to Mike Marini?
Hey, everybody.
I'm gonna just stop sharing my screen. And Mike, over to you.
Okay, so today we're just gonna talk about the basics of mortgages. So I'm just gonna pop on my screen. So this is the company I'm with. I'm a mortgage broker with Dominion Lending Centers, which we'll chat about what a mortgage broker is and does in a little bit. So first we'll start off with what is a mortgage. So a mortgage is a type of loan, and I guess we have to cover what a loan is. So a loan is where you borrow something from somebody and they want it back one day. So in this particular, yeah.
Are you sharing your screen?
Maybe not. Hold on. Let's see.
It's awesome. We can see you, but we can't see your screen.
Okay. Hold on. There. You can see it now?
There we go. Yeah, so if you want to start back.
Sorry.
So we could see, yeah. Perfect.
Okay, hold on. Mine isn't moving now. Here we go. So this is the company that I had said I work for, Dominion Lending Centers. So we're going to cover what a mortgage is. So like I was saying, a loan is where you're borrowing something from somebody and they're going to want it back. And in this particular case, it's money. So when people want to buy a house, they need to get money. They can purchase a house if they have enough cash, but houses are very expensive. So that's kind of hard to do. So that's where a mortgage comes in. So we ask different institutions. A lot of people use banks, but there's different ways of getting money to buy a house. And that's what a mortgage is. It's a loan where you receive money from somebody that you have to pay back over a long period of time so that you can buy the house. So why would you need a mortgage? Well, houses are very expensive. They can range from as low as probably $100,000 if you could ever find one to millions and millions of dollars. So if you had to save up enough money, you may not be able to buy one. And as you're saving up money to buy the house, the housing prices still continue to go up. So you keep saving, but the house gets more and more expensive, so you may never catch up to buy the house in cash. So that's where different institutions will lend you money in the form of a mortgage so that they can help you buy that house. So how do you qualify for a mortgage? So the very first and most important thing is that you have to have an income to do it. In Canada, it's a strict rule. So to have an income, that can come in many ways. You can have a regular job where you work for somebody and they pay you, or you can run your own business. Whatever way, shape, or form it is, the banks and any other type of mortgage institution are going to look at your income and debts. So debts would be something that you, again, owe other people, and any other type of loan. And they look at your income versus your debts to see how much they feel you should be able to afford for the house. So a good rule of thumb would be to use about 1/3 of your income. So by using only 1/3 of your income, that kind of covers and allows you to have extra money for savings and to pay for any other debts that you might have. So if we were to calculate it based on someone who is earning $100,000 a year, 1/3 would be about $33,000 a year that they should spend on a home. And if we then take that $33,000 and we divide it by 12 months, that tells us exactly how much money they're going to spend on a monthly basis, which is what we really want to know, which would be $2,750 per month. Still a lot of money. So mortgage payments aren't the easiest thing to calculate. So a mortgage payment can be done a couple different ways. Typically people will use mortgage calculators to calculate payments, but there's a really good rule of thumb that you can use for this as well too. If you break it down into small chunks, well, $100,000 is not necessarily a small chunk, but it's a manageable number. So a $100,000 mortgage is approximately $400 per month. So if we divide that 100,000 by 2, we can automatically figure out that $50,000 would be about $200 per month. $10,000 would be $40 per month. So a question for you guys: if 100,000 is $400 per month and 10,000 is $40 per month, then how much would $1,000 be per month of mortgage? If you know the answer to that, just pop it up in the chat box. So knowing these small increments and being able to calculate payments quickly, you don't need to use a mortgage calculator. The easiest way, obviously, is to use a mortgage calculator, in which case you can find a ton of them online. But when you do any searching online for mortgage calculators, you're going to find a lot of different calculators out there that only apply to the United States and not necessarily Canada, and they calculate their mortgage payments differently. So the link here below you can use to play around with a mortgage calculator and calculate different payments for yourself. So feel free to use that. I'm not sure if Stacey will pop that up later. So what is a mortgage rate? So when you get a mortgage loan, the way the banks make money is by charging you interest on that loan. So a mortgage rate is the rate of interest that they're charging you on the money you're borrowing. So interest is typically accounted for as a percentage of the money that you're borrowing. So that's how the banks make their money, or any lender that's lending you money for a mortgage. So there's a couple different kinds of mortgage rates you can have. One is a fixed rate mortgage, and a fixed rate mortgage means that the mortgage rate itself will not change, and you can get it in different lengths of time that they guarantee you that rate for. But the purpose of a fixed rate mortgage is that the rate itself will not change on you. So the easiest way to remember that is word fix itself. So if you fix something, one way of looking at fix is that you're actually fixing something that's broken, but the other way is to affix. So affix something means that if I bolt something to the ground, that thing is not going to move. It's not going to change. And that's where that term comes from, is fix. It's not going to change on you for whatever period of time that you have the loan for. The other type of mortgage rate you can have is a variable rate mortgage. And this is a mortgage rate that will float. It'll fluctuate based on something called the prime lending rate. So that can be a little scary for some people because they don't know what their payment's going to be. If your mortgage rate is changing all the time, then your mortgage payment might change. So the only reason that you would really want to go with a variable rate is if that rate is lower than a fixed rate. And typically it is. So people can save money with a variable rate, but they run the risk that their mortgage rate might change and go up. And if the mortgage rate changes and goes up, so does your mortgage payment. And they could run into some difficulties in affording that mortgage later on. So what's a mortgage term? So I had mentioned briefly when we were talking about fixed mortgage rates that you have it for a period of time. And that period of time is called the term of the mortgage. So you have different terms. You can have them from as little as 6 months all the way up to 18 years. And what happens is that's the guaranteed period for the rate. So if we gave you a mortgage loan for 5 years and you got a rate of 2.6%, that means the lending institution or bank is charging you 2.6% on all of the money that you owe them. But they're going to guarantee that rate for you if it's a fixed rate for 5 years. At the end of the 5 years, you have to get a new mortgage with a new rate. So that rate is what we call would expire at the end of 5 years, it would end. So the mortgage term is the period of time that you have a guaranteed rate and other rules and regulations associated with that mortgage. The amortization periods. So the term is the length of time that you have the mortgage rate for and the guarantee of that mortgage. The amortization period is the length of time that we have the mortgage for. So mortgages are very expensive and they're for large amounts of money. So in order for it to be affordable for people, we have to stretch those loans over a very long period of time to make the payments small. And the longest is really 35 years, but in most cases, it's 30 years. So 30 years is a very long time to have a debt or have anything for that matter, but it's the only way to get payments affordable enough that people can buy properties. So if we look at this example, if you have a $300,000 mortgage, so a lot of money over 30 years, the payment is $1,200 per month. But if I take that same $300,000 and I only give you it for 5 years, your payment is $5,335 per month. So a massive difference. And it makes such a difference that you may not be able to afford the home anymore. So having these amortization periods for a long period of time allows people to keep their homes and buy homes. And that's mortgage basics. Thank you so much, KiddieNomics. Did anybody answer the question about $1,000?
Thanks so much, Mike. That was awesome. No, we didn't get an answer yet in the chat box.
Oh.
No, not yet. Maybe they'll go on after. And
you know, Mickey?
Do you know the answer?
No.
No. No, not a good calculator in her head. Not yet. We'll get there, right? We will post the answer on using hashtag AskKiddieNomics on our Facebook and Instagram page. So that'd be awesome. So we'll do it there. How's that? And Twitter.
Perfect.
So we just had a few questions because that was a wonderful presentation. So like, how does a person pick a rate between variable and fixed?
So it really depends on a couple different things. So one, do they like things fluctuating? Some people don't like change. So a fixed rate guarantees that the rate and their mortgage payment won't change on them so that they can budget. So if we have a job and we earn, let's say, $60,000 a year, and we get paid every week. Every week we have a set amount of money coming into our bank account and we have to pay our expenses, and the mortgage is the biggest one. So if we have a fixed rate, we know that our mortgage payment's never going to change, and that might give us some peace of mind. It'll let us sleep at night. But if you have a variable rate, it's going to change on you. So that might be better for somebody who doesn't necessarily have a fixed payment and fixed budget. They might have fluctuating income and can play around with rates and take advantage when rates are low.
Oh, that makes sense. So if you had you kind of know exactly what your mortgage payment would be, versus if you had a variable, it may fluctuate. So you have to be aware of if you could afford fluctuations in your mortgage payment. That's
right, yeah.
Awesome. We did have a question from the chat box.
Sure.
Can you repeat the question so that we could get an answer?
Okay, so I'm going to give you some clues with the question. So $100,000 mortgage is $400 per month. $10,000 mortgage is $40 per month. What is a $1,000 mortgage per month?
A $1,000 mortgage. I wish that could be the
So
case.
10,000 is, yeah, exactly. 10,000 is 40. 100,000 is 400. What's 1,000?
1,000 is 60
Per month? Well, if 10,000 is 40, 1,000 would have to be less than that. We guess $1.
That was close. Good guess. $1?
Is
Not
it right?
quite. Close, though. Really close.
$10.
No.
Close, but
Less
not
than-
quite.
$5.
We're just going to keep guessing.
$0.
So let's say, so 100,000 is 400 and 10,000 is 40. So there's
So
one
someone-
less zero, right? 100,000, sorry?
That's $7.
No.
No.
So we're taking zeros off, right? So 100,000 is 400. 10,000 is one less zero than 100,000, and it's $40, which is one less zero. So 400 down to 40 is one less zero. So 1,000.
Oh, we got it. We got one of our attendees said $4.
Yes, that's
Yay!
right.
You got the answer.
Hired.
That
My
wasn't
next
too
mortgage
hard.
That's
broker partner.
I was guessing, yes. Good job. That was a fun one, Mike. Thank you so much. So can you tell us, like, how many different types of, like, terms can a person have? And how do you pick the best term for a person? Because we've seen that you went through a 5-year term. Are there different types of terms? And then how do you select which term?
Yeah, so you can have terms from as low as 6 months to 18 years. So they can be a 1 year, a 2 year, a 3 year. So it depends on your situation. If you're older and you're about to pay off your mortgage and you think you can have your mortgage paid off in 2 years, then you probably don't want a 5-year mortgage. You probably want a 2-year or less because you want to time it so that you don't have a mortgage longer than you really need it for. If you are going to have this home for the rest of your life, then you probably want something longer. So 5 years or longer, but it would depend on the rate. So if the rate for a 10-year is double what it is for a 5-year, you might go with a 5-year because the rate is so significantly cheaper and your payment is cheaper. It's easier to afford. So affordability and the mortgage rate and your circumstances. So whether or not you're going to move or you're selling a home or you don't need a mortgage anymore, those things are factors.
Oh, okay. Well, that makes sense, right? Yeah. Here's another question. What kind of careers can you get involving mortgages? Like, what is a mortgage broker? What do you do? And what kind of careers could you get in mortgages?
So a mortgage broker is someone who helps people get mortgages, and we deal with up to 90 different lenders. So there's credit unions, there's companies called monoline lenders that only deal in mortgages, there's banks, there's private lenders. So you can get a job working for any one of those lenders, or you could be a mortgage broker. Mortgage brokers are self-employed typically, so we work for ourselves, but we represent all of the lenders. So if you go to a bank, you'll deal with someone at the bank and they're working for the bank, helping them do mortgages. So that's a job. Or you could be a mortgage broker who represents all of those people. So really you'd be working for either one of the institutions that gives out mortgages, or you'd be a mortgage broker like myself.
Wow, there's so many different types of career choices that you could get to finance their homes.
Yes.
You do know.
Well, thank you very much, Mike. If there's
You're
any
very
more
welcome.
questions in the chat box, let us know. But Mike, that was awesome. Yep, we've answered.
Thanks for having me.
Thank you so much. Can you stop sharing your screen and we'll.
Oh yeah, totally. One sec.
Thank you. Awesome. 1 second, guys. So here's one last final question that we love to ask on every KiddieNomics webinar is, what would happen if kids became more financially literate? And our answer is real change that impacts the world. But tell us, let us know, what do you guys think? If kids became more financially literate, what do you think would happen? Okay. We also wanted to touch base on some upcoming weekly sessions that we're going to be having with our special guest experts. So next week is going to be with Joshua A. Campbell. He's a real estate broker with Coldwell Banker, the Real Estate Center. He's going to be next Friday, May 22nd. Joshua will be presenting Real Estate for Beginners. So this was the mortgage side, how to finance a home. Joshua is going to be speaking about the actual house, the property. So he's going to do Real Estate for Beginners next week. And then that's going to be followed up with a series with April Mullings, who's a bookkeeper, income tax provider. And she's going to be presenting on Friday, May 29th, budgeting. This is going to be a big one, everybody. Yes, budgeting, right? So budgeting, and then the following Friday is going to be June 5th, and that's going to be assets and liabilities, which will be another good session. And then Friday, June 12th is going to be all about taxes, which you guys probably don't know that much about at all, right? But that's going to be all about taxes. So that's going to be the upcoming sessions for about the next month. So if you guys want to log on and register for those webinars, that would be amazing. So just to a final thing, we just like to thank you guys for joining today. We would also love to hear any ideas that you guys may have about any other type of topics that you want to cover for KiddieNomics. Right after April's session, we're going to get into some credit, so that's going to be awesome. But please feel free to email us, or please like and follow us on Instagram at KiddieNomics, Twitter at KiddieNomics_, Facebook, and our YouTube page using hashtag KiddieNomics or Ask KiddieNomics. This session is recorded, so you will be seeing it on our YouTube channel within the next couple of hours. It usually takes a couple of hours to get uploaded. So you'll see it soon on our YouTube channel at KiddieNomics. So thank you once again, Mike, for coming on today as our guest expert for mortgages. We learned a lot, and please feel free to continue the conversation. Oh, and one last thing, sorry, the activity. So if you guys can go on to either the website that Mike posted, I will post it under our YouTube page, or CMHC website, and just check out different types of mortgage amounts. There's different mortgage calculators there, and you can put in, you can play around and see how much a $500,000 payment would cost, or $1 million mortgage would cost. You can do that on either one of those sites, so that would be amazing, and let us know what you think. All right? Thank you guys so much for joining us, and we'll see you next week. Bye. Bye.